For the potential market impact here at home, let's bring in market forecaster Jim Bianco, Bianco Research. Jim, great to have you with us. There's a lot to discuss, but in terms of the CPI print, this has not, in your mind, put to bed the concerns about inflation going higher?
Yeah, this number was a statistical mess. They assumed that rents in the United States were effectively zero for the month of October. They surveyed the second half of the month because the government was shut down. So when you see things like apparel falling and airline tickets going down, that's because they picked up Black Friday sales. They didn't pick up any of the pricing before Black Friday. And so there's a lot of questions that have to be answered because of the unique circumstance of it being the first number after a shutdown. And so you saw this in the market, that the 10-year yield, which should have looked at this number as being very bullish, was down 1 basis point after this number was released.
Mm-hmm. So you have this. So you have maybe the underlying belief that the Fed will have to keep rates higher than maybe what the markets are anticipating at this pricing in. And then you have the impact of the BOJ and their rates high, so basically lifting globally rates. I mean, how do you see this playing out into 2026?
Well, two things. First of all, you're right. The Bank of Japan is having a meeting for us in the United States overnight. There's a 95% chance they're going to raise rates to the highest level in 30 years. Their 10-year note is on the verge of going above 2% for the first time in also 30 years, too. What's driving this? They've got the highest inflation. They have more inflation than the United States for the first time since the 1970s. And you're seeing this with all of the central banks in around the developed world. The only central banks that are expected to cut rates in 26 are the U.S. and the U.K. The ECB, the Bank of Japan, the Swiss National Bank, even the Bank of China are all expected to either hold or raise rates next year. Why? Because inflation is elevated everywhere in the developed world, except maybe a little bit in China. But then they've got some their own special circumstances. But inflation is still a problem. So,
hey, Jim, it's Tim. I agree. And I know folks are actually happy to see some inflation in Japan for the first time in 3 decades. You know, be careful what you wish for. I'm just curious, really, your view on the technical side of this, because I do think also there are a lot of Japanese investors. It's not that they're going to stop buying U.S. Treasuries, and it's not that there's obviously still not a differential that would be favoring owning U.S. 10 years. But there's no question that Japanese insurance funds have been major buyers of Treasuries, and their market's a lot more interesting right now. Does this impact the long end of our curve?
It can. The Japanese are the largest foreign buyer in the world. China is number 2. Actually, China's number 3 now. The UK is number 2. And so you're talking about the largest buyer now looking at their home market and saying, you know what, we don't have zero rates anymore like they did for 20 years. We've got a competitive rate. You're right. The U.S. still has 4% 10-year notes. They have just under 2. So we have a higher yield. But that spread is narrowing and will probably continue to narrow because the Bank of Japan, when they raise rates tonight, are going to signal they're going to keep doing it in 2026. So that narrowing will continue to drive Japanese money back home. And that will be a loss of a big buyer over time gradually for the United States.